All right, look, navigating financial markets, it can feel like trying to find your way through um, a dense fog sometimes.
Oh, absolutely. There's just so much information swirling around.
It's overwhelming. But what if you had a clearer guide, a tool to really, cut through that noise?
Something to show you what's actually happening beneath the surface.
Exactly. And that's what we're doing today. We're diving deep into one of the most foundational tools out there for traders and investors, moving averages.
Right. We've looked at this really comprehensive guide, Mastering Moving Averages for Trading and Investing.
Yeah, and we want to give you the ultimate shortcut, distill it all down.
And, at its heart, a moving average is pretty much what it sounds like. It's a way to smooth out all that choppy price data.
Like ironing out the wrinkles.
Kinda, yeah. Think
Yeah.
of it like blending all the daily ups and downs together.
So you can see the underlying current, the trend.
Precisely. It helps you spot those trends, potential shifts, even helps pinpoint timing for trades.
Being in or getting out.
Yeah. And today, we're going to focus mainly on two big ones, the simple moving average, or SMA,
Okay.
and the exponential moving average, the EMA.
Got it. SMA and EMA.
We'll also touch on a third one, a bit quieter, but quite powerful, the smooth moving average, or SMMA.
Okay, let's unpack this then. What is a moving average fundamentally? You said it smooths things out.
Right. It's basically a constantly updated average price over a specific period you choose.
So it recalculates all the time.
Exactly, making it much easier to see patterns you'd otherwise miss in the day-to-day noise.
Now, you mentioned the two common types, the SMA.
Yeah, simple moving average, that one's pretty straightforward. It's just the arithmetic average of the closing prices over, say, the last 20 days, 50 days, whatever you pick.
Okay, simple enough. But then the EMA, you said it's different.
Right, the exponential moving average. The key thing here is weighting. It gives more weight to the most recent prices.
Ah, so recent action counts for more.
Exactly, which means it reacts faster to new information, to price changes.
Okay, I can see why that might be useful. So why do traders and investors use these MAs so much? What's the big draw?
Well, their versatility is, I think, the main reason. They're incredibly popular because you can use them for a lot of different things.
Like what?
First off, identifying the trend direction. Is the market generally heading up, down, or just, topping sideways? MAs give you a clear visual.
Okay, trend spotting. Makes sense.
They're also great for spotting potential reversals points where a trend might be running out of steam and changing direction.
Or confirming a trend is still going strong.
Exactly, trend continuation. And beyond that, they often act as dynamic support and resistance levels.
Dynamic meaning they move with the price.
Right. Unlike a fixed horizontal line, these MAs adjust. Price will often pull back to an MA and find support in an uptrend or resistance in a downtrend.
Interesting.
And maybe most critically for traders, they're used to generate specific buy or sell signals.
How's that work?
Often through crossovers, like when a shorter-term MA crosses above a longer-term one, or simply how the price interacts with the MA itself.
Okay, so let's dig into that EMA then. You said it's faster. That sounds really powerful, especially for active traders.
It is. That sensitivity is why active traders often favor it. It helps them potentially catch moves earlier than an SMA would.
But does that speed ever, backfire? Does it give more false signals in messy markets?
That's the trade-off, absolutely. In really choppy sideways markets, its sensitivity can lead to more signals, and yeah, some of those might be false alarms. It's not perfect.
Okay.
But for traders trying to capture momentum, that faster reaction time is often worth it. The calculation itself involves something called a smoothing factor.
A smoothing factor.
Yeah, it basically tells the average how much importance to give to the very latest price data. It ensures that new information gets factored in quickly.
Making it more responsive.
Exactly. Now, when you look at the common EMA periods people use, they each tend to have a role.
Right, like different tools for different jobs.
Precisely. The 9 EMA, that's super short term, good for scalping, really quick intraday moves.
Scalping meaning very small, fast trades.
Yeah, in and out quickly. Then you have the 20 EMA, still short term, but often used for confirmation on swing trades or slightly longer intraday setups.
Okay.
The 50 EMA is a big one. It often represents the medium-term trend and acts as a really key dynamic support or resistance level. Lots of eyes are on the 50.
I've heard about the 50 EMA.
And then for the really long view, you get the 100 EMA and especially the 200 EMA. These are major trend indicators, often reflecting what larger institutions might be looking at.
The big picture trend.
That's right. So let's maybe walk through some specific strategies because how you apply these EMAs really changes with your time frame.
Good idea. Let's start with intraday, say 5-minute or 15-minute charts. What are traders doing there?
Okay. Two popular approaches come to mind. First is the EMA crossover. This is all about momentum. You'd look for a buy signal when the faster EMA, often the 9, crosses above the slower one, maybe the 20 EMA. That suggests bullish momentum is picking up.
And a sell signal is the opposite, 9 crossing below 20.
Exactly. Signals potential bearish momentum. The second strategy is using price pullbacks to the EMA.
So waiting for the price to come back to the average.
Right. In an established uptrend, maybe price is above the 20 EMA. You don't chase it higher. You wait for it to dip back, to pull back to the 20 EMA.
And then you look for a reason to buy.
Yeah, you look for some kind of bullish confirmation right at that EMA level. Maybe a bullish candlestick pattern like a pin bar.
A pin bar. That's the one with a long tail.
Right. Small body, long lower tail, showing buyers stepped in. Or maybe a bullish engulfing candle. Then you might enter long.
And the opposite for a downtrend, pulling back to the EMA and looking for bearish signs.
Precisely. Pull back to the 20 EMA, look for a bearish candle, consider a short trade.
Okay, that makes sense. Waiting for a better entry.
And a really, really crucial tip here, especially for intraday, but honestly for any time frame.
Yeah.
Always try to trade in the direction of the higher time frame trend.
Don't fight the bigger current.
Exactly. So for instance, on your 15-minute chart, you might use the 50 EMA as a filter. If the price on the, say, 1-hour chart is above its 50 EMA, you only look for long setups on your 15-minute chart.
Only swim with the tide.
Pretty much.
Yeah.
If the 1-hour chart is below the 50 EMA, you'd only look for short setups intraday. It helps filter out a lot of bad trades.
Can you give an example, like from the source material?
Sure. Imagine looking at Nifty on a 15-minute chart. The 20 EMA is clearly rising, indicating an uptrend. Price pulls back right to that 20 EMA line.
Okay.
At that level, it forms a nice bullish pin bar. And maybe you check the RSI, the Relative Strength Index.
That measures momentum, right?
Right. And let's say the RSI is above 50, showing good momentum. That combination pullback to a rising EMA bullish candle RSI confirmation, that's a potential long entry.
And you'd put a stop loss where?
Typically just below the low of that pin bar candle to limit your risk if it doesn't work out.
Got it. That's a solid intraday setup example.
Mm-hmm.
Now, what about swing trading? People holding trades for, say, a few days or weeks, using maybe hourly or daily charts.
Yeah, the principles are similar, just scaled up. For swing trading, often on 1-hour, 4-hour, or daily charts, a common setup uses the 20 EMA and 50 EMA.
Okay, the 20 and 50, yeah.
Right. If the 20 EMA is consistently above the 50 EMA, that signals a pretty solid bullish trend. Swing traders would then look for opportunities to buy when the price pulls back to touch either the 20 EMA or the 50 EMA.
Using them as those dynamic support levels you mentioned.
Exactly. There's also something called the EMA reversion strategy.
Reversion, like reverting to the mean.
Kind of, yeah. After a strong run-up, price often snaps back towards the average, like an elastic band. It pulls back to the 20 or 50 EMA.
And that's an entry point.
It can be a re-entry point in an ongoing trend. You'd want to confirm it, though, maybe with RSI or looking for MACD divergence. MACD is another popular momentum indicator.
Okay, so using pullbacks within the trend, what about the really long-term folks? Investors looking at daily or weekly charts.
For them, the 50 EMA and especially the 200 EMA become the really big players. You often hear about the golden cross and the death cross.
Yes, I've definitely heard those terms.
The golden cross is when the shorter-term 50 EMA crosses above the longer-term 200 EMA. It's widely seen as a major bullish confirmation, suggesting a significant shift into a longer-term uptrend.
Okay, bullish signal.
And the death cross is the opposite.
Yeah.
The 50 EMA crosses below the 200 EMA. That's considered a major bearish signal.
Suggesting a long-term downtrend might be starting.
Right. But here's a nuance often missed. It's not just the cross itself.
Yeah.
The angle of the cross and how much the EMAs separate after crossing can tell you a lot about the potential strength and follow-through of that new trend. A steep cross with widening AMAs is often more powerful than a shallow, flat one.
Interesting detail. Angle and separation matter.
Definitely. Another strategy for long-term investors is simply buy the dip to the 100 or 200 EMA.
So in a strong uptrend, wait for price to pull back to those really long-term averages.
Exactly. It helps investors add to positions or get in without feeling like they're chasing the price at the very top. These long-term MAs act as significant potential support zones.
That makes a lot of sense for managing risk over the long haul. Listening to this, that advice about always checking the higher time frame trend, it seems critical. Have you, seen people get burned by ignoring that?
Oh, all the time. It's probably one of the most common and costly mistakes.
Really?
Yeah. I've seen traders, hyper-focused on a 5-minute chart. They see a bearish EMA crossover and jump into a short trade.
Okay.
But they completely ignore the fact that on the daily chart, the price is strongly above a rising 200 EMA, which is acting like a massive support floor.
So they're shorting right into major support.
Exactly. And they get squeezed out as the larger trend just reasserts itself. It's like trying to swim against a really strong tide. You might fight it for a bit, but eventually the bigger current usually wins.
That's a great analogy. Don't fight the tide. Now, you mentioned EMAs. There's another visual way to use them, right? The EMA ribbon.
Ah, yes, the ribbon. It's a neat visual technique. Instead of just one or two EMAs, you plot a whole group of them on the chart.
Like how many?
It varies, but a common set might be the 8, 13, 21, 34, and 55 period EMAs, for example, all plotted together.
And what does this ribbon tell you?
It's fantastic for visualizing trend strength and potential changes. When the ribbon is neatly stacked, shortest EMA on top in an uptrend, longest on the bottom, and fanning out, that indicates a strong, healthy trend.
Clearly moving in one direction.
Right. But if the ribbon starts to compress, flatten out, or the EMAs start intertwining and crossing each other,
That's a warning sign.
it often signals that the trend is weakening, consolidating, or maybe even reversing. You can also watch for momentum shifts within the ribbon, like price crossing above or below the faster EMAs in the group. It's like a multi-layered look at the trend's health.
A very visual confirmation. Okay, so EMA gives us speed, ribbons give us a visual on strength, but what if you want something calmer, less reactive, something that filters out even more noise for a clearer long-term picture?
That's exactly where the smooth moving average, the SMMA, comes in.
SMMA. Okay, how is this one different?
Think of it as a bit of a hybrid, sort of between an SMA and an EMA, but with its own unique calculation that makes it very slow to react.
Slower than both SMA and EMA.
Much slower, especially compared to the EMA. Its whole design philosophy is to dampen those short-term fluctuations much more heavily and really emphasize the underlying stable trend. It gives significantly more weight to older historical data compared to an EMA.
So it's less sensitive to recent price spikes or dips.
Way less sensitive. The calculation itself ensures that past values have a longer lasting influence. If the EMA is like a speedboat, quick and agile,
Yeah.
the SMMA is like a giant oil tanker. It takes a long time to change direction, but once it's heading somewhere, that direction is usually pretty meaningful and stable.
Okay, the supertanker analogy helps. What are the main benefits then? Why use something so slow?
Well, that slowness is its benefit in certain situations. First, it filters out a tremendous amount of market noise. All those minor wiggles just get smoothed away.
So you get a cleaner line on the chart.
A very stable, smooth line. This makes it excellent for identifying the true underlying trend direction, especially in markets that aren't super volatile or moving slowly.
Good for quieter markets then.
Yes, or just for confirming a major trend. And because it's so slow, it helps avoid many of the false signals you might get from faster EMA or even SMA crossovers, particularly when the market is just chopping around sideways.
Fewer false alarms and choppy conditions.
Exactly. If you were to compare them directly, SMA has medium sensitivity, EMA is high sensitivity.
And SMMA.
Very low sensitivity. It reacts the slowest. This means it has very low noise levels, but it also has the highest lag.
Lag meaning it's behind the current price action.
Considerably behind, yes. So it's a trade-off. You sacrifice responsiveness for stability and noise reduction. You wouldn't use it for quick entries.
So how do you use it? What are the strategies? Let's start with intraday again.
Okay, for intraday, using, say, a 5 or 15-minute chart, the SMMA's role is almost purely for trend confirmation, definitely not for timing entries.
Just to know the general direction.
Precisely. You might put a 20 SMMA or 50 SMMA on your chart. If that SMMA line is steadily grinding higher, you only look for long trades using other faster signals.
Like maybe an EMA crossover or a price action pattern.
Exactly. If the SMMA is pointing down, you only look for shorts. You absolutely must combine it with faster indicators for your actual entry trigger because the SMMA itself is just too slow. It just tells you which way the big ship is generally pointed.
Got it. Trend filter, not entry signal. What about swing trading? Hourly or 4-hour charts?
For swing trading, you can use the 20 or 50 SMMA again as a filter, but combine it with price pullbacks. similar to the EMA strategy, but expecting a slower confirmation.
So, plot the SMMA, wait for price to pull back to it.
Right. And then look for a clear reversal candle, like a hammer or engulfing pattern right at that SMMA level. You'd still want to confirm with maybe volume picking up, or an oscillator like stochastic showing oversold conditions in an uptrend pullback.
And the benefit here compared to using EMA for pullbacks.
The main benefit is its ability to filter out more noise during consolidations or sideways periods. It can help you avoid getting chopped up by fake breakouts or breakdowns that might trick a faster EMA.
So, more patience required, but potentially cleaner signals in some conditions.
That's a good way to put it. And for long-term investing, daily or weekly charts.
This seems like where the SMMA might really shine, given its stability.
It does. For investors, the 100 SMMA or 200 SMMA are excellent for long-term trend tracking. If the price is consistently staying above, say, the 200 SMMA on a weekly chart, that's a very strong indication of a major bull market.
A very clear, smoothed-out trend line.
Exactly. Investors can use pullbacks to these very long-term SMMAs as opportunities to add to positions, viewing the SMMA as a significant dynamic support level.
Can you give an example for the SMMA, like you did for the EMA?
Sure. Think about the Nifty 50 index on a daily chart. You apply a 100-period SMMA. Let's say the price has been trending above this smooth line for months, just grinding steadily higher.
Okay, clear uptrend confirmed by the SMMA.
Then the price finally experiences a deeper pullback, and it comes down and just touches that rising 100 SMMA. Right there, it forms a bullish hammer candle.
Showing buyers defended that level.
Exactly. For a long-term investor using the SMMA, that touch and bounce off the smoothed average confirmed by the candle could be a signal to buy or add to their position, trusting that the major underlying trend identified by the SMMA is likely still intact.
Riding the long, smooth wave, essentially. Avoiding the smaller ripples.
That's the idea, significantly reduced whipsaws compared to faster averages.
Now, this leads perfectly into combining them. You mentioned an advanced combo strategy, SMMA plus EMA. This sounds like getting the best of both worlds.
It can be a really effective approach, yes. It tries to leverage the strengths of both.
How does it work? What's the setup?
Typically, you'd use a longer-term SMMA, like the 50 SMMA, primarily to determine the overall dominant trend direction. That's your main filter, your North Star.
Okay, SMMA for the big picture trend.
Right. And then you overlay a much faster email, like the 9 EMA, to pinpoint your actual entry timing within that trend.
Ah, using the EMA's responsiveness for the trigger.
Exactly. The core logic is only take trades in the direction the 50 SMMA is sloping. If it's sloping up, you're only looking for long entries.
No shorting if the SMMA is rising.
Correct. Then, within that context, you wait for the price to cross above the 9 EMA as your entry signal.
And confirming that signal.
Definitely want confirmation. Maybe look for RSI to be above 50, indicating some underlying strength, or wait for a bullish Maggie crossover to confirm the momentum shift that the EMA cross is suggesting.
And the reverse for downtrends. SMMA sloping down, wait for price to cross below the 9 EMA, confirm with RSI below 50 or bearish max ED.
Precisely. This combination is powerful because the slow SMMA filters out a lot of counter-trend noise and keeps you aligned with the main flow.
While the fast EMA gets you into the move relatively quickly once it seems to be resuming.
Exactly. It aims to reduce false signals while still providing timely entries. It's a nice balance.
You know, what's fascinating here, listening to all this, is that whether you pick the EMA for speed or the SMMA for smoothness or combine them, there seem to be some really crucial universal rules or tips that apply to using any moving average effectively.
Absolutely. These are super important reminders, regardless of which MA type or period you choose.
Okay, let's nail these down. What are the must-knows?
First, and maybe most importantly, remember, moving averages are lagging indicators.
Lagging meaning they react after the price has already moved.
Yes. They follow the trend. They don't predict the future. They tell you about the past and the present trend, not what's going to happen next. Big distinction.
Okay, the reactive, not predictive. Got it.
Second, always combine MAs with other forms of analysis. Don't rely on them in isolation.
Like what other forms?
Volume analysis, price action patterns, like those candles we mentioned, other indicators like RSI, MCD, stochastics. Use MAs as part of a toolkit, not the whole toolbox. They need confirmation.
Don't put all your eggs in the MA basket.
Nicely put. Third, avoid indicator clutter. Don't plaster your chart with 10 different moving averages.
Analysis paralysis.
Exactly. 2 or 3 well-chosen MAs are usually more than enough. Keep it clean and focused.
Okay, keep it simple.
Fourth, Be aware that moving averages tend to perform poorly in choppy, sideways, or range-bound markets. They generate a lot of false signals when there's no clear trend.
So trend identification is key before relying on MA signals.
Crucial. If the market's directionless, MAs lose a lot of their effectiveness. Confirm there's actually a trend to follow first.
Makes sense.
Right.
What else?
Fifth, you need to tailor the MA period to your time frame and style. What works for a scalper on a 1-minute chart, like a 9 EMA, is useless for a long-term investor on a weekly chart, who might use a 200 SMMA.
Adjust the settings to fit the job.
Right. And related to that, sixth, always incorporate multi-time frame analysis. We talked about this, but it bears repeating. Check the trend on higher time frames, like daily if you trade on the 4-hour, to confirm the bigger picture.
Don't get lost on the lower time frame.
Exactly. And finally, a practical tip. Most good charting platforms like TradingView allow you to set alerts for MA crossovers or price crossing in MA.
Oh, that handy.
Yeah, use alerts. They can notify you of potential setups without you having to stare at the charts all day long. Saves time and mental energy.
Great practical advice there. Okay, so wow, we've covered a lot of ground.
We certainly have.
From the absolute basics of what a moving average even is, digging into the fast-reacting EMA and its uses across intraday, swing, and long-term trading.
Right, and the EMA ribbon strategy too.
Yeah, that visual ribbon. Then shifting gears to the super smooth SMMA, understanding its noise filtering power and how to use it for confirmation and long-term tracking.
And that combo strategy, bringing SMMA and EMMA together.
Right, plus those crucial universal tips. I feel like this deep dive has really provided a shortcut, a way to get properly informed about these foundational tools.
Hopefully it clears up how they differ and how they can be practically applied, depending on what kind of trading or investing you're doing.
Understanding them really does feel empowering, giving you more clarity in the markets.
Absolutely. And, knowledge like this is always most valuable when it's not just passively understood, but when you actively think about how to apply it.
How can you, the listener, use these insights?
Exactly. Think critically about how understanding EMAs versus SMMAs or the importance of confirmation could potentially refine your own approach to analyzing the markets. Hopefully it helps you navigate with a bit more clarity, maybe more confidence.
Definitely food for thought. And it leads to a final question, something to maybe mull over. Considering how moving averages, by their very nature, are based on past price action.
Where are you going with this?
Well, what might be the next step in financial analysis? What are people exploring to try and actually anticipate future market shifts rather than just reacting to trends that moving averages show us have already begun?
The million-dollar question. Moving beyond lagging indicators.
Yeah, something to think about. What lies beyond simply following the trend?